Good evening, everybody. Welcome to Trading Capital. It is March the 2nd, and as we head into another wild action, let's jump right into the hot commodity that everybody's discussing, oil. We're looking at the WTI crude oil here, and oil once again has had a strong close. In fact, it has been over a decade since oil closed at these highs. That is incredible, folks. Even on the back of Biden announcing last night at his special State of the Union press, basically announced the U.S. will be releasing 60 million barrels from the reserves to try to cool the inflation and the price of Russia and combat what's going on in Russia and Ukraine. And ultimately, that's the reason why oil is at the price and lofty levels that it is currently at, because it's far superseded the price that most people thought. I hear a lot of price figures going in the range of basically 140 to 150. I personally don't think it gets that level because it will put tremendous amount of pressure on the economy and collapse it. And frankly, I don't think this is the decline that the Federal Reserve and policymakers want to see. And on the back of history, if you study, with the high prices of oil always put insane amounts of pressure on the overall stock market and economy because it's an input cost for everyone. It is one of the major inflationary factors that dictate where inflation goes. Despite them not including all the energy costs, it still dictates the inflation narrative because it affects everything, life as we know it. That being said, let's jump right into the price action of oil. Here you had oil open and right away it began to sell, over this pivot high. You opened and it began to sell. But the power of oil managed to power through, make a new high, consolidate, make a new high, come back down for a test of the previous breakout pivot high, and then it pushed even higher. But notice how every time you've made now a higher high, the drop is getting bigger and you're taking out the previous drop. Same thing here. You made a higher high intraday and the drop is getting bigger. And markets started to rally at this point, and I'm very surprised that markets didn't start to fade and they closed as strong as they did, just because oil once again started rallying to its all-time highs. And what's very interesting is that on this attempt, oil failed to take out its high. So will we see continued downside? If it's following this short-term trend where it makes a higher high and then a lower low, a higher high and then a lower low in the short term, it could be a sign that oil has reached the top. But yet again, with the war in Ukraine and Russia, that's obviously the fundamental that is driving the price of oil. The technicals, in my opinion, are still screaming overbought. You have in the short term this widening megaphone pattern. And if oil doesn't break out and go and hit, per se, somewhere in the range here, then ultimately I do think you have more downside ahead. It'll only be a matter of time before you break this downtrend line, and then you're going to be looking at a lot lower prices, in my opinion. This is just the intraday analysis. We continue to short oil here at Trading Capital. A lot of people think we're crazy, but in my opinion, even if we have to hold this trade for 1 to 3 months, I'm prepared to do that because there's such a good risk to reward ratio at these levels. I just want to show you on a weekly basis what the price of oil is doing. So essentially, why I'm shorting this at these levels again and adding to my shorts is because look on a weekly basis, we're running into all these pivot highs. We have 4 pivot highs here, 1, 2, 3, and 4. Let's draw some trend lines across just to show you the resistance that the price action is currently facing. So we'll take that one and then we'll draw a line here. So if you notice these 4 key levels of resistance, today's price action, now we'll go back to the daily and then back to the intraday analysis. So if you look at the daily, and we actually did close and we tagged that resistance. So we've tagged 3 major resistance points that go back over a decade. And that is very strong resistance that you have to respect until proven otherwise. The next big resistance is at 114. If you take that out, basically the resistance point after that is the all-time high in 2008, which I don't think we go to test even with the fundamental backdrop. I think oil's gone parabolic. It's certainly had its tremendous move, negating the crazy spike in oil here from the announcement of the war, which was here. Oil still had a tremendous move to the upside, and you were trading in this wide megaphone pattern range that technically, once this breakdowns, you have a tremendous amount of downside in oil, likely all the way down to the bottom of this channel. And look at the price action. Whenever you see something go straight up like this, and again, I am recognizing it is on the fundamental backdrop of a war, but the war has been announced now. Countries are going to combat it. I think the price squeeze in energy is going to come down. It has to. I'm in the camp that we do see a peaceful resolution in the near term. There's a couple factors and potentially speculative insights by analyzing the charts as to why I think that. And we'll go through that. But ultimately, we're shorting oil at these levels via the SCO. It's crazy extended. Surprisingly, if we look at the markets, the S&P still had a positive green day. And it's still consolidating in this range on a daily basis. And that is actually very bullish for the index and the stock market. As long as it starts consolidating in this range, it favors an upside breakout. That being said, you do have the 200 and the 50-day approaching very quickly. However, you can still break through that in the short term. You also have an interim trend line that basically connects those highs. So if you break through this level, just be aware there is tons of resistance with this downsloping trend line, with these moving averages. On an intraday basis, let's analyze the price action. So over here you had the open, you gapped up, and then right away you started selling off. And that was probably on the back of oil rallying. However, the weird and interesting phenomenon is that the market started to power through and rally despite the price of oil also rallying. So that is very interesting observation. And what's key is that you did take out the pivot high up here, just briefly, but you closed under it. So that area of resistance has now been weakened. And now look to break out and test some of these pivot highs up here, which will coincide with on a daily basis with the moving averages, as well as this downsloping trend line. I do think this move breaks to the upside, as it technically is still a bullish pattern, but we'll just have to wait and see what transpires. Looking at the Nasdaq, also a very good day, despite yields back popping around 10% today. The US 10-year, the Nasdaq still had a powerful day. Notice how you have a bearish death cross here on the daily basis, as opposed to the S&P on the daily basis. You do not have that death cross occurring yet. So it will come. A lot of the times people trade on simple patterns like this alone. It's not enough to fundamentally drive a high probability trade, but it is a factor that you should consider and observe during your analysis. If you look at the Russell has actually the most relative strength, which is very interesting. And one of the reasons the markets rallied today, despite the oil price skyrocketing and closing at it over a decade high, is basically, I think, for one simple fact. You had the chairman, Jerome Powell, testify in Congress today, and he was grilled, asked a bunch of questions regarding the state of the economy, the war, etc., and policy. And essentially, he outlined in the March meeting, which was to be expected, and what the Fed had outlined was that we will definitely see that 0.25% interest rate hike. And that's exactly what I expected. Some people were calling for 0.5, some people were even calling for 1% after Bullard announced it on CNBC. Just frankly, never listened to what is being aired on CNBC. Take it with a grain of salt. I don't think they ever point you in the right direction, at least not in the short term. Longer term, sure, they could be right on a few things, but a lot of the times in the short term, the price is manipulated, and I just don't trust them. I use them as a sentiment indicator, but again, basically analyzing what they say and looking at what they do are usually two different things, and that's what you have to be aware of. But that being said, the Russell is holding up the best. Federal Reserve Chairman Jerome Powell, I sensed a tone of dovishness in his voice, although he was trying to put on the straight face and the serious ball cap that he is here and ready to tackle inflation, which I think they will over the longer term. It's just going to be more persistent and not transitory as they thought. It's probably going to be an 18 to 24 and possibly month longer process, at least drawing the inflation rate down from the current levels to roughly, I would say, 3 to 4% will be the new norm. That being said, I still sense the dovishness in his voice regarding the war in Ukraine and Russia. The Federal Reserve loves a good excuse to use and loosen policy and not become as aggressive. I support them supporting Ukraine because it's definitely, there's a lot of people in need. But ultimately, when you look at the ramifications of what is transpiring in our economy, we have still inflated bubbles to the extreme. The fiat system has ultimately created more destruction than any war is probably going to create once this bubble collapses. So it's not a matter of what event is more important. I think in the long term, the fiat system has created an ultra destruction that will pop eventually. Not to be as pessimistic, let's try to stay optimist. I am hoping the markets go higher in the short term because we are long key positions at key levels. So seeing a nice bounce continue before we can exit our longs with a nice profit and start looking to short will certainly be ideal. That being said, we're always ready to adjust and pivot. So notice the relative strength on the Russell. It didn't take out its pivot low here as opposed to the QQQ, which took out its pivot low there, made a new low there. The spiders also made a new low by taking out that low. So out of the three indexes, the Russell is the best and has the most relative strength right now because a lot of the small caps have been decimated. Things like Net, Oracle, a lot of the bank stocks, they have all been decimated, and now they're starting to catch a little bit of a bid. Affirm is another one. But if you just had to scroll down the list, there's tons and tons and tons of them that comprise this index. Looking at gold, gold is an interesting play. You came on a daily basis, you tagged this resistance, which is now support. And ultimately, I do think the pattern goes lower in and around to the 1830 to 1840 range, which will be the original breakout trend line. And basically, I think it'll be a good position to re-enter. I do hold gold. I've been holding gold. My most recent buy was basically here December 15th, and I've caught this whole run up. I did sell a bunch of it, but I'm looking to re-enter basically in and around this trend line range, 1830 to 1850 area. 1840 will be the sweet spot in my opinion, but we'll just have to see how the price action gets there. On an intraday basis, it's very intriguing as to what transpired. Basically over here, you open, gold started to dump, popped up, consolidated, hit your support levels, and then ultimately went lower, hit the first resistance, which was your resistance line where you broke out here, but since it was resistant and now acts as support, and you've bounced off of that. Now every time you hit a key level, you've hit it here once and you've hit it here twice, that trend line of support becomes weakened. And basically think about it, when you hit it, you damage it. It puts like a small crack in it and another small crack until ultimately when it hammers on it again, it breaks and heads lower. And that ultimately supports our thesis here at Trading Capital as to why gold should go lower in the short term. It has had a tremendous move for its asset class, but it is getting a bit extended. Ultimately in 2022, I do think you go to test the all-time high at 2074. So if you have more of an investor mindset, certainly holding onto your gold and not trading in the short term is probably not a bad idea. Let's take a look at the DXY and why I think it is going to put pressure on gold and support our thesis here for a lower gold price in the short term. Basically, the US dollar is still on a tear, massive strength. Since basically the start of the new year, it's just been on a tear to the upside, trading in a nice range here, hitting the high, coming down, hitting the high, coming down, hitting the high again. Ultimately, you should see a small pullback, but I do have an upside price target priced in around the $98 range, a pierce of 98. That being said, I think the US dollar is catching a bid because you're starting to you still have the Ukraine-Russia fear in the market. And until that fear subsides, the US dollar is always the one currency that people from around the world run to because it has the biggest GDP, the biggest economy. So if anything, the US dollar is going to be the last person to default, or the last country to default on their debt, theoretically. That being said, 98.40, I think once you hit that range, then you start rolling over and it'll be the next up leg for gold. Silver's holding great relative strength here. You've had that short-term breakout and you're actually hovering around that breakout. Now, if gold goes lower, I do think silver goes lower, especially if the economy starts to weaken and show cracks and weakness in employment numbers or growth or higher inflation. Higher inflation tends to keep silver going up. However, I think with the fundamental backdrop of a weakening economy, it will put the industrial side of silver in a bit of a pinch where you won't have much of capital chasing silver for the demand aspect, which is pretty important. It's about a 50-50 ratio. Let's jump into Bitcoin. Bitcoin's, again, one of the most talked about assets. It's one of my favorite things to trade here. Bitcoin's interesting. I think we're putting in this clear defined range that we're trading in, and it's been profitable on both swings so far for trading capital. So here, I think we're in this range here for a couple reasons. First off, if you look at the fall of the head and shoulders M-top pattern here, and you compare it to the M-top pattern that we fulfilled here, you fell and you created this range for roughly 2 months. And had you been able to play the up and the downsides of this range, buying low and selling high, you would have been able to make an immense amount of profit, all while the trend was choppy. And that's the beautiful thing about trading, is if you can identify a high probability range, you can generally profit from it while the market is generally going nowhere or trendless, directionless. So we're chopping sideways. We've hit the bottom of the range. Trading capital bought. We didn't know that was the bottom of the range it was going to be. We just had massive support in here during the original down shift. That's why we picked it up. We didn't sell all the way at the top of the range. We actually got up out of it right at this impulse bar and banked our profits because we were unsure of the power of this downtrend. The reason we sold there was because you ran into some major resistance here. You broke out of the trend line. I thought you were going to get a retrace initially right back after this power move. We didn't. We continued to go upwards, and basically you hit the top of this trend line. And notice where the top of this pivot hit. This is where the breakdown happened, the major sell-off and breakdown happened. And you had all this support here, hit, before it finally broke. So it was a big support area. Lots of pivots traded in here before the pattern finally broke. And now you've came up to test it again, failed, you've come back down. But ultimately you've held up a little bit better. You've shown more relative strength, basically because you didn't take out this pivot low and you didn't hit the bottom of the range. But now you've shot up again and you've testing that upper range again. And it looks like you're failing. But the question will be now is, will we consolidate bullishly in the upper range here before it breaks out of this range? That's going to be the key question. Ultimately, if we look at where the neckline is on this, I think you do have the power to break out of this range and trade a little bit higher. But that being said, you have to respect the resistance that lies up ahead. You not only have the original breakdown of the neckline from this M-top pattern, which is here, but you also have the range, these pivot lows, and you also have the 200-day moving average slowly starting to slope down. So there's tons of resistance in and around this area. And for trading capital, we actually exited our short-term swing position for roughly 10 to 15% in Chainlink, Bitcoin, Solana, Luna, and Ethereum. We played those 5 and a little bit of BNB, and basically caught some great profits off of both of these swings. But now we're out. Full disclosure, we've closed all of our positions because I don't know if it's going to be going to break out. And even if we break out of this range, there's still lots of resistance up ahead that the risk to reward ratio is not in my favor. Ultimately, we still are in a downtrend. And the question is, will we come back down to test this low here? That is ultimately the question. I think it's going to coincide with the stock market. Notice how we've had a bounce in Bitcoin. Also, the major indexes have also bounced. Looking at interest rates have popped 10% today. That's on the back of Chairman Jerome Powell officially announcing what they will be doing in the March FOMC meeting, a rate hike of 0.25%. The markets like certainty. They like to know the direction. There was a little bit of things up in the air based off of the Ukraine-Russia news, not knowing how the Fed will react. But now that the markets know how the Fed feels and reacts, and that they're going to be a little more supportive if the war escalates, and the fact that they've given us the identification that a quarter basis point hike is on the horizon, the markets like to know and price that in right away. That being said, there were some earnings as well. Snow reported earnings. We did a little bit of a day trade, caught roughly 6.5%. The reason why is if you look on the daily chart, Snow missed on earnings, basically gapped down over 30%. Initially, I wasn't going to trade this until I saw it came into this huge support zone, its previous pivot high. Now, you have to be careful with stocks like these because Snow is still a new name, but it did have enough data in the short term for me to take a small stab at it. And the reason why we bought in at this current price was we actually bought in and around this green line, 185.07, but in this current market, what I've been observing is that, especially during the day trades that I've been doing, the markets have been slicing through key support zones and minor support zones. So taking the more conservative approach in this macroeconomic backdrop is probably the wise thing to do. That being said, charts are looking to make lower lows and higher highs on a technical basis. This orange line is the low, the new low that it made, and technically it did make a lower low, which stands to suggest that it can have a bounce from here on in if the spiders and the other indexes keep pushing up. So a 30% gap down is huge. Again, on an intraday basis, just take a look at that drop, a massive drop. On an intraday basis, we roughly banked this green area, or it wasn't quite 7.9. I think it was 6.5%. This may have just been adjusted incorrectly, but it was around 6.5%, and now we're out. We don't like to hold things overnight, especially during the uncertainty of the war, and since we technically are in a downtrend. A couple other things I want to look at are banks, key banks that showed some amazing reversals. I guess there's Citigroup. Thank you. So take a look at this reversal on Citigroup. That is incredible. What a power move. And out of all the banks, Citi's reversal technically looks the most beautiful because it's put in this distinguished tail, this bottom, and it's had this massive rally completely engulfing the previous candle, and this is on a daily basis, as well as coming into and closing in the mid body of the secondary close candle over here. Roughly a 7% reversal on the day. That is extraordinary for banks. They were getting clobbered on the back of being tied to Russia sanctions and having investments in Russia. Now, the reason I'm bringing up Citigroup, and if you compare all of the other banks, had reversals today too, but they were all inside bar reversals. So if I show you one, for example, like JPM, take a look at the candle here. It was more of an inside bar reversal. It's not technically as strong and as pretty. All of the banks pretty much finished the day like that, an inside bar reversal. Whereas opposed, you look at Citigroup, and Citigroup has almost like this bottoming tail action. Very, very strong reversal. The strongest reversal out of all the banks. And what's interesting about this is out of all of the major banks in the US, Citigroup has the most exposure to Russia. I'll say that again. Citigroup has the most exposure to Russia. What is that signaling? If this had the best reversal, the strongest technical reversal, is that potentially displaying maybe a resolution or some sort of diplomatic approach to the war on the horizon? From insiders that I know who have family living in Ukraine, apparently the media, what we're seeing here on TV is that Ukraine is putting up the solid fight. But from people that are living in Ukraine, from what I've heard and know, they say Russia troops have moved in everywhere and pretty much taken over completely. And I believe that. I really do believe that. So is this signifying potentially a diplomatic, resolution on the horizon? It could be. Putin's a very smart man. He doesn't want to be fighting in springtime where the grounds are wet, heavy equipment vehicles get stuck. He also loses his stranglehold on Europe in the form of energy. His natural gas and oil prices would significantly decline during that seasonal period where the demand isn't as needed, especially in the natural gas area. That being said, just a close, interesting eye to keep your eye on Citigroup as it has the most exposure to Russia. If we look at the RSX, the Russian ETF, it's really, really interesting because today, intraday action, just look at on a daily basis how beaten down this is. It is an extraordinary drop. Gap down after gap down after gap down after gap down. It's really incredible. And just if we take a look at basically the move down, in 2 weeks it's fallen 72%. That is incredible. It's pretty much caved it, collapsed it. However, what's interesting here is off the lows today, and today was pretty much one of the better days that we've seen the RSX react. And off the lows today, it had a 48% swing. Imagine that, a 48% rally off of the lows before it hit the top of that trend, this resistance area, and then started to consolidate sideways. And this is still technically bullish consolidation because it's all inside of this big bar. So it does stand to reason that we could point to higher prices on the RSX. That being said, this ETF is completely at the risk and helm of headlines and what transpires in Russia. So it's a major speculative risk. But it's just interesting to observe certain correlations because the price often leads the news. I'm a firm believer in that. And when we start to see these ETFs really turn around and start making a little bit more technically strong bullish patterns, perhaps rounding bases, but I don't think this will be a rounding base. I think it's going to be a pop, by 40, 50, 60%, even 100%. This thing can rally just like that before. If it had to reach the highs before it completely caved, it would have to rally up basically 238% from where it currently is. From the lows today, it would have to rally up 328%. So the power of the downside moves is extraordinary. This thing can go back up to 100% in no time, and you could make a killing on it. But you have to be prepared that this thing could get halted, your money could get trapped, they could get delisted, whole sorts of risks and approaches. That's why if you do take a stab at it, it's you have to be prepared to basically lose that money, and it's more of an option play in my eyes, and it's something that you do not risk a lot of capital to. I'm just going to scan the radar to see if there's anything else on the horizon. I think that is it. A lot of the marijuana stocks were under pressure today. China was under pressure, but we'll have to see how the price action tomorrow shapes up. I'm going to be keeping an eye on the futures. Be ready for more alerts. I will be looking to exit certain positions and start shorting other positions if the markets catch a bid. That being said, happy trading everybody, and take care.